If the market tells you what something is worth every second, why do fortunes rise and fall as if those numbers mean nothing at all? Every day, prices flash across our screens: green for hope, red for fear. Investors cheer when they climb, panic when they fall. And yet, the companies behind those prices may not have changed at all. A business that earned a steady profit yesterday still earns it today. Its factories, patents, customers, all remain the same. But the crowd's opinion of that business can swing wildly in a single afternoon. So what then? Is it really worth? That question, what is something truly worth, is the heartbeat of intelligent investing. And it was the question Benjamin Graham asked nearly a century ago, in an age when speculation ruled, just as it does now. He saw that investors were often guided not by logic, but by emotion, by the thrilling illusion that price and value were the same. But they are not. Price is what you pay. Value is what you get. And between those two lies the entire art and sanity of investing. To most people, the market is a scoreboard, a place where rising prices feel like victory and falling ones feel like failure. But Graham saw something different. To him, the market was a servant, not a master, a voting machine in the short run and a weighing machine in the long run. Its daily votes could be erratic, even foolish, but over time it would weigh the true worth of businesses with unrelenting accuracy. That insight, simple yet revolutionary, led him to create one of the most enduring concepts in all of finance: intrinsic value, the measure of what a business is truly worth, independent of the market's mood. Because if you can understand intrinsic value, you are no longer at the mercy of the crowd. You become, in Graham's words, an intelligent investor, one who acts on reason, not reaction. And so, in this episode, we'll trace that journey, how Graham discovered this idea in the wreckage of the Great Depression, how he defined it with logic and humility, and how his philosophy remains our compass in a world still ruled by speculation. Because to understand intrinsic value is to understand why we invest at all, not to chase prices, but to participate in the real creation of wealth. It was the early 1930s, and Wall Street was in ruins. The great bull market of the 1920s had collapsed into despair. Fortunes vanished overnight. Men who once spoke in millions stood in breadlines. The glittering promise of endless growth had given way to one sobering truth: no one really knew what anything was worth. Benjamin Graham was among the few who dared to ask why. He had entered Wall Street young, brilliant, analytical, and ambitious. By his mid-20s, he was earning more than the President of the United States. But when the crash came in 1929, it spared no one, not even him. His funds lost nearly 70% of their value. The safe securities he had trusted turned out to be illusions built on speculation, not substance. Graham later wrote, "The investor's worst enemy is not the market itself, but his inability to distinguish price from value." That distinction between the market's opinion and a company's reality became his life's obsession. He saw that the market, for all its sophistication, behaved like a manic-depressive partner, euphoric one day, despondent the next, offering prices that swung far beyond reason. But beneath that chaos, the real businesses, the ones with assets, earnings, and enduring prospects, continued to operate, to produce, to create wealth quietly.
To Graham, this was the revelation. If prices could swing wildly while the real business stayed the same, then there must exist a truer, steadier measure of worth, one that lived beneath the surface of speculation. He called this measure intrinsic value. And it was not a mere number on a chart. It was the economic truth of a business, derived from its fundamentals, its capacity to earn, and the margin of safety it provided against uncertainty. In the dark years following the crash, Graham began to teach and write, first at Columbia University, then in the pages of Security Analysis, 1934, outlining a method to restore reason to investing. He sought to transform the market from a gambling hall into a place of calculated judgment. He taught his students, among them a young Warren Buffett, that investing was not about predicting the future, but about understanding the present, about separating what something costs from what it is worth. Nearly a century later, we can see the elegance of that idea. When the world was blinded by price, Ram rediscovered value. When emotion ruled the market, he anchored it in logic. And that is how intrinsic value was born, not from formulas, but from humility, from the realization that the market's voice cannot be trusted unless it speaks in facts. Because, as Graham would remind us, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. And what it weighs, always, is value. So what exactly did Benjamin Graham mean by intrinsic value? He described it as that value which is justified by the facts, by assets, earnings, dividends, and definite prospects. Not by predictions, not by opinions, but by facts, tangible, measurable, and verifiable. In its simplest form, intrinsic value is the true worth of a business, as opposed to the market price it happens to trade for. It's what a rational owner would pay for the whole enterprise, not what a crowd of speculators might bid for a few shares. Think of it this way. If you owned a small grocery store, you wouldn't wake up each morning wondering what someone might offer for it today. You'd measure its worth by what it earns, what it owns, and what you expect it to produce in the years ahead. That, in essence, is intrinsic value. It's the price justified by the reality of the business, not the emotions of the market. Graham often reminded his readers that intrinsic value cannot be determined with mathematical precision. It is always an estimate, based on reasonable assumptions about the future. But, he argued, an imprecise estimate of intrinsic value is far superior to precise ignorance of price. Because while the market's quotations can change by the minute, the underlying value of a sound business changes only gradually, as earnings grow, as assets accumulate, as management creates or destroys shareholder wealth. This is why Graham urged investors to focus on facts, not forecasts. To study balance sheets, income statements, dividends, the slow, steady heartbeat of real business activity, instead of reacting to every whisper of market sentiment. He wrote, "Investment is most intelligent when it is most business-like." And in that single sentence lies the essence of intrinsic value, the idea that a stock is not a piece of paper to be traded, but a share of a real business to be owned. To Graham, knowing the intrinsic value of a company was like having a compass in a storm. It didn't predict where the winds would blow, but it showed you which way was true north.
And once you learn to see through that lens, the market no longer feels like chaos. It becomes a landscape of opportunity, where you can calmly wait for the market to offer you prices far below what something is truly worth. That, for Graham, was the cornerstone of all intelligent investing. Understand what something is worth. Then, and only then, decide whether the price is fair. Benjamin Graham never intended intrinsic value to be a mystery. He wanted it to be a discipline, a way of thinking that any serious investor could learn and apply. And while his formulas have evolved with time, his reasoning remains eternal. To Graham, estimating intrinsic value was not about precision. It was about rationality. It was about grounding every decision in what he called a sound and adequate basis. Facts, not forecasts. He began, as always, with the fundamentals. A company's earning power, its assets, its financial strength, its dividend record, and its stability over time. From these, he sought to determine what a rational buyer would pay for the entire business, not in a moment of excitement, but with a clear mind and a long horizon. In his classic works, Security Analysis and The Intelligent Investor, Graham often approached valuation conservatively. He assumed no heroics, no perfect future, no endless growth, just the sober arithmetic of what a business could reasonably earn and sustain. He expressed this idea in simple terms that could guide even the most humble investor. One of his illustrative formulas, later popularized in his writings, was intrinsic value equals earnings per share times 8.5 plus 2 times expected growth rate. It was not meant to be exact, only a framework. The 8.5 represented the fair value of a company with zero growth, a baseline reflecting average earning power. The 2G allowed modest room for expected growth. But the real insight wasn't in the equation, it was in the discipline behind it. Because Graham knew that the greatest danger was not in miscalculating growth, but in assuming too much of it. He warned that optimism, when unexamined, becomes speculation disguised as analysis. And so, he taught that the intelligent investor must always allow for uncertainty, to build a margin of safety. If your estimate of intrinsic value suggests a company is worth $100, you don't rush to buy it at $95. You wait for $70 or even $60, a price that gives you a cushion against error, emotion, or unforeseen change. He called this the margin of safety, and it became the foundation of value investing. It was not pessimism, it was prudence. It recognized that the future is unknowable, and therefore the wise investor must demand a discount large enough to protect against his own fallibility. In Graham's words, you don't have to know a man's exact weight to know he's fat. The intelligent investor, likewise, doesn't need perfect calculations, only reasonable evidence that a business is undervalued in relation to its fundamentals. This method, simple, factual, conservative, allowed investors to act calmly while others speculated wildly. It replaced guesswork with logic and emotion with process. And in doing so, it turned investing from a gamble into a discipline. Even today, nearly a century later, every serious valuation method, from discounted cash flows to enterprise value analysis, traces its philosophical roots to Graham's framework. Because at its heart lies the most rational question in finance. What is this business truly worth, and am I paying less than that worth demands? That is the essence of intrinsic value, not a formula, but a framework for thinking sanely in an insane market. Nearly a century has passed since Benjamin Graham first wrote about intrinsic value, and yet the same human tendencies he warned of, greed, fear, impatience, still dominate our screens.
Today, markets move faster than ever. Algorithms trade in microseconds. Social media can send a stock soaring before lunch and crashing before dinner. Analysts debate interest rates, central banks, and quarterly guidance, often with the same fervor gamblers bring to a roulette wheel. In this environment, Graham's calm logic feels almost ancient. And yet, it has never been more relevant. Because while technology changes, human nature does not. The average investor still confuses price for value, still assumes that what rises must keep rising, and what falls must be broken. Still seeks excitement instead of understanding. But the intrinsic value of a business, its ability to generate cash, to sustain growth, to endure, remains just as real, just as measurable as it was in 1934. The only difference is how easily it's forgotten. Graham once said that investing is most intelligent when it is most businesslike. If he were alive today, he'd likely repeat that advice unchanged, perhaps with a raised eyebrow at the spectacle of meme stocks, hype-driven IPOs, and speculative cryptomanias. He would remind us that a company's stock is not a lottery ticket. It is a claim on real assets and real earnings. Consider two modern examples. One is a company with a strong balance sheet, consistent profits, and a durable product, but whose price has fallen because the market's attention has shifted elsewhere. The other is a firm losing money year after year, valued not for what it earns, but for how loudly it's promoted. Which, Graham would ask, offers a margin of safety? Which reflects intrinsic value, and which depends on the kindness of future speculators? The intelligent investor's task is the same as it has always been: to separate value from popularity, to distinguish between a business and a bet. In modern terms, intrinsic value can be approached through methods like discounted cash flow analysis, asset-based valuation, or even comparative metrics, but the principle never changes. Estimate what the business is worth under reasonable assumptions and pay significantly less. That's it. That's value investing, stripped of noise, free from prediction. And yet, few practice it. Why? Because it requires patience in a world addicted to immediacy. Because it demands humility when everyone else seeks certainty. Because it asks you to think independently when the crowd is loudest. Benjamin Graham called that independence the secret weapon of the intelligent investor, the ability to stand alone, grounded in logic, when others are ruled by emotion. He knew that markets will always tempt us to trade on impulse, but he also knew something deeper. The market eventually weighs value. Always. And those who have the courage to wait, armed with knowledge of intrinsic worth, will, in time, be proven right. As Graham's most famous student, Warren Buffett, later summarized, in the short run, the market is a voting machine. In the long run, it is a weighing machine. And what it weighs, even now, is the same thing Graham measured all those years ago: intrinsic value. At its core, intrinsic value is not just a financial principle. It is a philosophy of mind. Because to live by intrinsic value is to see through illusion, to separate fact from feeling, signal from noise. It's not just about what a company earns, but about how an investor thinks. Benjamin Graham understood that the greatest challenge in investing was never the market. It was the mirror. He wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." Why? Because even the soundest analysis means little if the investor cannot control his own emotions. Fear makes us sell too soon. Greed makes us buy too high. And impatience, that quiet whisper of restlessness, destroys more wealth than ignorance ever could.
To follow Graham's path is to train the mind toward rationality and restraint, to remain steady when others are swept away by euphoria or despair. He often said that an intelligent investor must develop a temperament that is independent of the market's behavior. That independence is what we might call the investor's inner compass, a quiet center of logic that points to truth even when the crowd moves in the opposite direction. When prices fall, that compass reminds you value does not vanish with volatility. When prices soar, it whispers a rising price is not proof of worth. And when uncertainty fills the air,
It helps you return to the only foundation that matters, the facts. This, Graham believed, was the true measure of intelligence in investing. Not brilliance, not prediction, not timing, but emotional control guided by principle. It's the discipline to think in years, not days. To measure success not by whether the market applauds you today, but whether you've acted rationally, with margin and patience. This is what separates the investor from the speculator. The speculator looks to the market for validation. The investor looks inward, to his analysis, his reasoning, his calm conviction. And so, intrinsic value becomes more than a calculation. It becomes a mirror for the mind, a way of testing whether our actions are rooted in logic or in impulse. As Graham wrote, the essence of investment management is the management of risks, not the management of returns. And that risk, more often than not, lives within us, in our inability to sit still, to think clearly, to trust in reason when emotion reigns. The intelligent investor's true mastery, then, is not of numbers, but of self. Because when you learn to anchor your thoughts in intrinsic value, in what is real, measurable, and enduring, you are no longer tossed by the market's tides. You become, in the deepest sense, free. So what then does all this mean for you, the modern investor, standing in a world of constant noise? It means that every decision begins with a simple, timeless question. What is this business truly worth? Not what will the stock do tomorrow? Not what does the market expect next quarter? But what is it worth? That question alone, asked consistently, separates the intelligent investor from the crowd. To practice Graham's philosophy in your own investing, you don't need to predict the future. You need only to observe, to measure, and to reason. Start with the facts: a company's earnings, its stability, its assets, its record of performance. Estimate conservatively what it might earn in the years ahead. Then demand a margin of safety, a gap between what you think it's worth and what you're willing to pay. Because in that gap lies your protection against error, against volatility, and against yourself. Graham's students, from Warren Buffett to countless others, have built entire careers on this single discipline. Buy only when the price is meaningfully below the value. Hold with patience, and never forget that markets are there to serve you, not instruct you. When the market offers a bargain, you buy. When it offers folly, you decline. When it panics, you stay calm. And when it rejoices, you stay humble. Because in the long run, price always returns to value, as surely as a pendulum returns to its center. Graham once wrote, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." His message was never about chasing perfection, but about building wisdom, about cultivating the patience, discipline, and humility that make good results inevitable over time. The market will continue to shout, louder, faster, and more confidently than ever before. But the intelligent investor will always listen to a quieter voice, the voice of value, reason, and evidence. Because while prices change, principles endure. An intrinsic value, that calm measure of truth beneath the market's noise, remains the investor's North Star. Follow it, and you may not always move with the crowd, but you will walk with clarity. If you found these ideas meaningful, consider joining us on this journey to keep Benjamin Graham's wisdom alive. Subscribe, share your thoughts in the comments, and help preserve the art of rational investing, one timeless lesson at a time. Because together, we can ensure that Graham's quiet logic continues to guide new generations of investors toward patience, reason,
and lasting value.